Welcome to Centennial Advisors. We use our cutting-edge technology and collaborative client-focused brokerage team to provide the highest level of professional service at all stages of our clients' investments. Our team has decades of experience in all types of markets, guiding clients through some of the most challenging times for investors. Our all-hands-on-deck approach generates more offers on your listing, and according to CoStar, we have sold our listings faster and with the highest list-to-close percentages over the past 2 years. For buyers, we identify and negotiate the best terms possible, ensuring your long-term success. We hope your time with us today helps your passive investments become massive investments. Centennial Advisors, here for you now and always.
Good afternoon. It's January 2023. I hope everybody's off to a great new year. Out here in California, we've been inundated by rains for weeks and have a number of clients with mold issues they don't normally encounter, erosion and roof leaks. And because of that and what we see happening in the marketplace, Jason and I thought it would be a great opportunity to talk more in depth about triple net leases, the pros, the cons, the reasons why people buy them, and then the questions that people ask us to make sure they're picking the right one for what they'd like to accomplish. So as regularly, I'm joined by Jason Brooks of Buckhalter. Jason, thank you for joining me. It should be a fun hour today as we talk a lot about net lease property and why people like to buy them, how they work out really well for people that might be career owners in other products. I know that I think between both of our client lists, we have a lot of what we would call active owners of apartments and retail and office property that over time in their investment career turn to net lease properties as an attractive vehicle for capital preservation and I would say enjoyment. And so it'll be fun today to talk about why people buy them and then what are the right questions to ask, what are the concerns that people have and you know how what information is important in addressing those concerns. And so it should be a fun afternoon. Thanks for joining me, Jason.
Thanks for having me. Looking forward to it. I think net lease deals are something that I've become more passionate about, or you've seen me become more passionate about over the last few years as an opportunity for clients. So I'm looking forward to talking about it.
You know, maybe we start there, Jason, because I know that beyond just your desire to help clients get into them because you think of the benefits, I know you've got a personal plan or desire. Why don't we start there and you talk a little bit about kind of what you want your portfolio to look like 25 or 30 years from now?
I mean, my goal 25 or 30 years from now, or even hopefully 20, is to own a portfolio of just net lease investments where, you know, our clients have become really accustomed to what we refer to as mailbox money, but rents are often showing up, you know, days before that they're due. And, you know, we get to enjoy our life, whether it's going to play golf or travel. And I think that would really fit a nice lifestyle. And so my goal is to ultimately own a handful of these if I'm lucky enough and I work hard enough. So hopefully what I'm preaching now will be able to execute on my own behalf in the future. But I like the stability of the tenant, especially with when we get the right ones. I like that they pay on time or early, and the lack of management allows for a really nice lifestyle for the owner. You don't have to worry about any issues at the property when the tenant is, you know, hopefully it's full triple net. If not, it's going to be some form of, you know, modified double net. And, you know, the tenant takes care of most of the work, which really allows you just to enjoy your life and the fruits of your labor previously that have allowed you to buy these opportunities.
Well, I actually think it's going to be a great year for these opportunities, just as much as we've seen cap rates move in the last 60 to 90 days. With some of the other things we're seeing in the marketplace, I think this year might be the year that you end up getting the first one of that long-term portfolio. But let's start, before we get into why people buy them, let's get into the basics just real quick. What is a single tenant triple net leased investment? What does somebody get when they get that?
So when you buy a single tenant triple net lease property, you get a building. You own the building oftentimes. Occasionally there's some other structures, but generally you own the building and you have a single tenant in the building. The single tenant occupies the entire property. So you only have one tenant paying rent to you. And that tenant if it is a full triple net, that tenant is responsible for everything. They are responsible for property tax. They are responsible for insurance. They are responsible for all building maintenance and upkeep if it is a pure triple net. And we can talk about some of the modifications to that as we get further into the day. But they are responsible for covering all costs. So whatever the rent check is that you receive is money you get to put in the bank, subject to taxes, obviously. If you have a loan payment, you would pay the loan payment first, but you don't have to worry about any of the other operational costs or ownership costs that you would normally in a, let's say, an apartment building. You don't have repairs, you don't have maintenance, you don't have turnover, you don't have property taxes. So there's a single tenant paying your rent. And like we've said before, Justin, if you have a really strong tenant, I mean, there's obviously a Starbucks on the screen, but Starbucks, 7-Eleven, some of these big public companies, your risk is very low. Your risk is that the company goes out of business, or they, which we'll get into, maybe move locations, but that's where, your team of advisors comes in at Centennial to help you find the right location that we would refer to as like a very sticky location where the tenant's not going to want to leave. And if they do, someone else is going to rush in to get the space right behind them.
So in addition to the things that Jason mentioned, why do people like them? Why are they convenient? Oftentimes somebody has a piece of property that is more management intensive, more labor intensive, and they can utilize selling whatever type of building they currently have, whether it's apartments or office, retail, storage, industrial, basically anything with a residential rental, anything with an income stream. And these satisfy a 1031 exchange because they are income producing real estate. So Jason, let's talk a little bit about, and maybe we'll compare, maybe the easiest thing to do is compare them a little bit. But sure. Why do investors like these? First one that I want to get into is that you get a long-term stable income stream. Maybe talk about that a little bit, compare that to, multi-tenant retail or really any type of product. What is somebody typically getting when we talk about a long-term stable income stream?
Right. So let's say I'm going to talk about us buying like a new property. So let's say we choose to buy a new property, right? Your first initial lease term will range anywhere from 10 to, I've seen up to 25 years. That's pretty rare. It's usually 10 to 20. Oftentimes you'll see 13, 15, or 20. The reason being is traditional financing wants a 10-year term in order to commit to the loan. And so they'll often give you some buffer. So 13 years often the starting point, although there are some 10. And so you get the same tenant committed to you, often to almost always with a form of a guarantee for that initial term of 10, 13, 15, or 20 years. And then they almost always come with anywhere between 2 and 4 extensions of 5 years each. So you're potentially looking at that lease being active for anywhere, from 20 years on the short side to 40 years on the long side, with that same tenant being able to be committed to you for that long without any lease renegotiations, without any, other TIs requested for a new tenant to come in. They're committed to you for the long haul.
Fantastic. And we'll get into one of the concerns in a second, which is, I only have one tenant, but maybe speak to the other side of that, the benefits of getting a well-established, successful brand and business operation.
So the first thing is you don't have any, like in an apartment, right? You don't have any loss to lease, any turnover, any downside, any lack of cash flow during a period where you might have to float the loan or something like that. So you do have one consistent person paying the rent. And as you know, Justin, like one of the first things we do is as part of the tenant transfer process is we oftentimes fill out ACH paperwork for the client because the money is not sent via check anymore. It is direct deposit, auto deposit, straight from the corporation's account, straight into the client's account. And like I said, often days before. So if you have a very strong, stable tenant, you're essentially just buying a monthly payment, right? Like this is, I've taken my equity. I'm going to get some appreciation most likely. I'm going to, the building, the area is going to go up in value, hopefully, but you're getting a payment against your equity every single month, for the duration of the lease. And if the advisors work with you and we find you the right property, hopefully you're going to have either, if you don't sell it, if you choose to hold it, that property could be occupied for, a very extended period of time, 20, 30, 40, 50 years.
Yeah, I think one of the other benefits often that maybe sometimes people, I don't know if they necessarily overlook it, but they don't factor it in, is that a lot of times the tenant in their current building, maybe if it's an apartment, is an employee in most cases at a business run by probably a mom and pop. Or if it's retail or office, it's a mom and pop business that may not have, more than a few years worth of established performance and history. Whereas when people get into these net lease properties, one of the great parts about them is that they are getting proven brands that have successfully grown their coverage, grown their market share, oftentimes across the country or at minimum regionally. And they have a proven track record of success and growth. And so oftentimes you're really upgrading, let's call it the quality of your tenant, when you move into a net lease property. And Jason, one of the things I think that sometimes people also, especially on the multifamily side, are starting to see a difference is the ability to really fully screen the tenant in detail and figure out who you're really getting. Whereas a lot of the legislation, especially in California today, makes it harder and harder for a landlord to figure out everything about an incoming residential tenant. And maybe you can talk a little bit about those changes for a second. But here, not only are you going to get to, you're going to be able to figure out who is the company, who's involved in it, what their track record is. Oftentimes, you're going to get financials not only on the company, but even on the store's performance, or you're going to get the information the company used to select the site because it fits their demographics, et cetera. So there's a lot more investigation you can do on your tenant than you can in some of the other products.
I mean, Justin, even one of the things you didn't mention is half the time you can Google their credit rating. They're public companies, right? Like there are companies out there that just grade the credit worthiness of those tenants. And so you can find out just how good your tenant is from those searches as well. And you brought up an interesting point about, the data that's provided regarding why they chose to put a store there. So one of the things I've talked a lot recently with clients about is, we showed a client, for example, and you and I walked through this deal, Starbucks in, I think it was Missouri, right? In a Walmart anchored shopping center. It was somewhat from what people in California would think of as, in the middle of nowhere. It was just in the middle of a bunch of, there was land on both sides. But what we determined and when we were explaining to the client is, first off, this is the only Walmart in like 100-mile radius, right? And everybody's going to come here, and it's on the main highway. And Starbucks has a team of people whose whole job is to decide where to put these at, right? So if you're doing a Starbucks deal in LA and you're paying a 3.5 cap, or you're getting the same corporate guarantee from the same tenant from the same company in Missouri, in a place where they're probably not going to build another one for miles and miles and miles, and that same guarantee exists at a 5.5 cap, why wouldn't you just take the higher return, right? Ultimately, they have a team of people that have spent hundreds of hours deciding that this was the location that they wanted, that it's most likely not going to fail, right? Like this is their job, is to make sure that when they put a facility in, that it's, that it's going to be successful. So I think that's one of the things I truly appreciate is you can understand not only why they chose to be there, but the quality of the tenant. You can look at the lease and the guarantee as well, because it might not be from a publicly traded company. It might be from a franchisee, but we've done deals where the franchisees were publicly traded, or the franchisees have 400 locations. They're doing hundreds and hundreds of millions of dollars a year in revenue, where their profit is 30, 40, $50 million. And just because they're not, publicly traded doesn't mean they're not successful. And they'll even show you their projected or their current percentage of rent as it compares to sales, which I know is a number that we've often looked at as well to figure out how much can their sales go down and have them still cover rent.
There are certainly a lot of advantages. The next one I think we'll talk about is kind of main locations, and you touched on it a second ago. Up on the screen is a transaction we did last year for a client who wanted California. And so they bought Delano, California, which is just north of Bakersfield. And so for some even California residents, they might not think this is Main and Main, but it certainly was Main and Main for the region. This is an area that's, let's call it 30 minutes north of Bakersfield. Off this exit As a part of the construction of this area, it included a Lowe's, it includes a Walmart, it's next door to a In-N-Out on a stretch of highway that has 68,000 cars per day. And you can see the numbers there. Those numbers were market when things were trading, but you get these locations where everybody's going by them now, and oftentimes more people will be going by them in the future as growth continues to fill in. As somebody who, for the better part of the last 40 years, has been driving up and down the 99, there's a lot more homes around this exit than there were before, and there's still a lot more that will be coming. So you have a tendency, because as Jason mentioned, you're getting a big corporation with a site selection department. You are getting the main location. And in a lot of these, especially in the quick service restaurants, you're getting the out parcels of the main location that are really highly desirable for not only the tenant that you got, but probably for a number of other tenants as well. Those are a couple of things why people like them. I think some of the other reasons or why these transactions are so successful is that they oftentimes create a win-win-win scenario for the buyer, the seller, and the operator of the property. Jason, you want to talk a little bit about how, of all the real estate transactions we do, these are often the most win-win-win transactions.
Yeah, absolutely. You have a tenant that wants to be there. They've obviously picked a new site. They're ready to open. They're happy, right? And Justin, you know this too. With the larger franchisees, they're often the one building the property, right? So they're building it themselves. They're signing their own lease and they're selling it to you. The reason being is it's too much capital for them. Their business is to operate a facility that makes hamburgers. Right? Their business is not to operate a real estate fund. And so they need to put that capital. They can take the money from the sale of this property and build 4 more, right? Between, after getting a construction loan. So they don't want it all tied up. So they're happy to sell you the brand new building and pay you the rent. The tenant wants to be open, and the developer seller is ready to move on to build, as I said, their next 3 or 4. And even if it's not the franchisee or the company building it for themselves, it's often they have a preferred developer for the region, and that preferred developer wants to go build the next 4. So they're also happy to just, sell it to you at a number that makes sense for everybody and get out of it and move on to their next deals, because they're not going to squeeze you for every dime, because their business is not to hold it long term, right? Like their business is to go build the next 4. And the longer they take to sell this one, the longer it takes them to go build the next 4.
And maybe just to repeat it, I know we talked about it a second ago, but give the short version of what the benefit is for an acquirer of these properties.
For the person buying it?
Yeah.
So first you get the cash flow. That's easy, right? You get depreciation. If you're putting, let's just say you have in 1031, you're putting in fresh money, you get depreciation. If you're 1031ing and you increase the price of the debt, you might get new depreciation as well. But again, then there's the passiveness, right? If you spend 10 hours a week managing your properties, you're going to get 10 hours a week back, right? And 10 hours a week doesn't sound like a ton necessarily, right? But that's 40 hours a month. That's a lot, right? You're looking at 500 hours a year. What could you go do with 500 hours of time?
Yeah. Jason, the next thing, and, brokerage wise, we always get asked, is there a lot of inventory? And whether it's at any stage of the market, any product, people are always asking us. And, we are brokers. We find inventory for people. But maybe for a second, since you sit in a different chair, you work with people that are acquiring a variety of different types of property, make a comment about the availability of inventory in the net lease space. Like when your clients are in an exchange or they're out seeking property to buy, when they're looking for net lease, do they see more or less product than they might see in LA apartments or Torrance retail or something like that?
I would say substantially more inventory, right? And you can there's more, even if you want to break it down by classification, right? Do you want, what we would call a QSR, a quick service restaurant? Do you want an automotive, whether that's, a Jiffy Lube or a Caliber Collision or something along those lines? Do you want, other things like, a paint store like Benjamin Moore or Sherwin-Williams? There's all different options. And these brands are, as the population moves and grows and expands, these brands are all building new locations. So there's constantly new inventory coming on the market. You and I talk all the time that the best deals this week won't be there next week, but there's going to be a new set of best deals next week that replace the deals that went off market this week, right? There's always new opportunity. And then, you and I are also talking a lot about the new product, but then there's also people reselling product, right? Some people want to look for some upside in deals, right? So maybe they're going to find one that only has 3 years left on the lease. And part of what their plan is going to be is go in and renegotiate a new long-term lease with the tenant, right? And that's going to be some value add. Oftentimes people get deterred from these situations because they say, well, my upside is somewhat determined, but it's limited, right? I'm going to get a 5.5 cap today, and I'm going to get 10% growth every 5 years for the next X amount of years. Well, instead, somebody might say, I love this location. I love this property. Raising Cane's would be crazy to leave. But if they do, In-N-Out Burger is going to come in anyways, and I can lease it to In-N-Out Burger, or someone else is going to really love to have this space. And there's my upside, right? A new long-term lease, fully financeable. So there are different ways to look at upside. And I think this is also, Justin, where your advisor comes in and makes a huge difference in understanding the market and what's the need of the market. You and I are talking about a random location in Missouri, or, as populations move and grow, we were looking at in Franklin, Tennessee, which is obviously one of the fastest growing markets. And, just outside Nashville, Williamson County, great place. There was a brand new construction Chipotle and Dunkin' Donuts. And it was next to brand new construction apartment building across the street from a brand new Lifetime Fitness, right? Like, it was great location on a main road. And we were like, man, if we had the capital available, it's like buying an Irvine 10 years ago, right? It's one of those things that, God forbid, should 20, 15 years from now, I think there are 15-year leases, the tenants wanted to leave, we would have zero issue re-tenanting for probably a much higher sum than what we were getting already. So it's about working with your advisor. They understand the intricacies of the market, and they can help guide you down the right path.
Yeah, we talk about that a lot. Where I grew up, there was a Del Taco and a Carl's Jr. that if they were on originally 20-year leases with 4 or 5-year options, they've gone through those just about now, and we're signing a new lease rate at market. And the rent increase over that period of time, yes, it's a long time, but that rent increase so significant because it was an area that only got denser over the last 40 years. To Jason's point, we talked that there's a lot of product available. There's a lot of product available because the first two, well, really all three of the groups on this, why people sell triple net properties. Developers sell triple net properties because they're in the business of developing property, and they make their profit from taking something from dirt to putting a building with a lease on it. So they don't hold them very often. As Jason mentioned, whether it's in this case oil changes or burgers or chicken, operators and franchisees make their money in the business, not in tying up their capital in the real estate. If they've gotten more, if they free up their capital, they can go acquire new stores and expand and grow their business. So we see a lot of product from the shift as franchisees buy each other, as corporations come in and kind of reacquire stores, and then we see those things come back on the market. And then the last one is heirs. The net lease property, a lot of our clients use them for retirement enjoyment. Successful operators of commercial property for years, they want to enjoy the later years of their life. They buy these, they drive in their motorhome, they travel the world, they do whatever. And somebody usually gets a stepped up basis and needs to sell them, wants to sell them. Jason, maybe talk for a second, not only about the ease with which anybody can operate these and why some families that have a very hands-on member or two that does management and maybe even repairs ultimately buy these to better set up their family, but then also talk about the ease with which next generations can realize the stepped up basis and the the equity that their family has built and get that out of real estate via net lease property may be easier than an apartment building or a shopping center or something like that.
Sure, absolutely. And so I think that the net lease transactions are highly liquid, right? For the most part, you're buying a cash flow, right? So it's really just crunching numbers and analyzing the quality of the tenant and any risk associated with the tenancy. So there are a wide variety of buyers, whether it's a private family, whether it's a high net worth individual, whether it's, a REIT. There are a bunch of different exit strategies, but these, as you like to say, tend to be the most emotionless transactions we do, because it truly is. It's you're buying something for X, and in return you get Y on a monthly basis. And so it's very straightforward. They're highly liquid. But the thing I'd like to point out too with the heirs item is they're great properties for your kids to inherit. They are great properties for your grandkids to inherit and pass down for a couple of reasons. One, they manage themselves. So if you're planning on giving if you have a trust set up where instead of giving your children the principal, you want to give them a monthly amount, these produce a monthly amount without touching the principal or damaging the principal. So they're a very strong asset for that reason. And two, Justin, and you and I see this all the time where family members, parents, grandparents spend a lot of time. They bought real estate in Southern California for highly inexpensive at the time relative to now value. And the kids or the grandkids want nothing to do with the business. They want nothing to do with operating, but the family doesn't want to just have the kids get cash. The family wants to keep the money in real estate, 1031, to your point, live off of the cash flow for a while and then have the kids inherit it. Well, the kids can inherit the real estate and continue to get the cash flow. It's almost like an annuity that you're setting up for your children to a certain extent, with the additional benefits of it being real estate. So that is something that is really cool. And I think that is a great way from an estate planning perspective to look at it. And we were, just to take a quick moment, we were talking about the return threshold and value add upside. Well, yes, you might only be getting a 2 or 3% increase on average annually, even if it's 10% every 5 years. But if you look at owning apartments in Southern California, right, RSO rent control, right, you only get a 3% annual increase. The last 3 years, you haven't been able to increase rents at all, but your expenses have gone up substantially, especially with inflation. And even if you're on AB 1482, you're 5% plus CPI. Right now, it's 10% cap. You hit the 10%, but your expenses are increasing at, let's say, 6 or 7%. And Justin, I know you own and operate some buildings, so you might know those expense increases better than I do right now. But I'm guessing your actual increase on your return annually is 2 or 3%, even if you're doing the 10% bump, right? So now you're getting a more stable tenant with about the same return as you would get in California.
And absolutely, Jason. I think that because of inflation over the last little bit, and maybe how lease structure had changed when we were in a very low inflationary period, the rent bumps and all that have become a little bit more of a talking point. But we'll get to it later and talk about what we're seeing in the market and how I'm already starting to see the response of sellers of net lease property and tenants starting to compete more on rent increases again. Just today, in looking at the emails that came out regarding new inventory, I saw more 10% every 5-year increases than I'd probably seen, 6 months ago, a significantly bigger amount. So we're starting to even see some adjustment on the inflation component of it. And that kind of goes to the next thing is, there are a multitude of options out there. Well, most of the time we work with capital preservation clients that are looking for ease of management, security, stable income stream, and we focus on the highest quality tenants in the best locations with the longest leases. There are investors that invest in these looking for properties that have 6 months or a year left on the lease and no rent bumps, and their rents might be half of what they could be today because they know that they're acquiring a great location and they're going to mark that lease to market and add a lot of value to the site. Also, therefore there's higher return options from these that are maybe more mom and pop tenants, or the locations aren't as dense or whatever it may be. But there is such a wide variety of what is available in this space that tenant wise, lease term, guarantee, rent increases, you can pick and choose those things and have an ample amount of inventory to work with. You want to go to the next slide? Jason's talking a lot
Justin,
about
we've had people that have come to you and said, I want this kind of tenant in these 7 states. And you'll come back and like almost trying to find a needle in the haystack. And then you'll come back with 15 options. And they're like, oh, okay.
You know, we don't have a slide for it, but one of the first ones we did was we helped a family sell a couple of apartments here in Southern California. And they traveled a lot, but they didn't fly. They drove places. And the wife, who was originally from Germany, loved Cracker Barrel. And this was what time when like you couldn't find, there was one Cracker Barrel, I think west of the Mississippi. It was like in Colorado Springs or something like that. And so that's what she really wanted, but didn't even think that she could get it. And we found her one just outside a mall in Dallas. And they've owned it, more than 10 years now. But yeah, oftentimes you can pick you can pick the tenant, you can pick the location. We'll get to an example of people doing that for vacation purposes here in a second. But Jason talked about mailbox money. You'll see these 2 buildings, or at least this story, a couple times in this presentation, but I'll give everybody the quick overview. That building on the older building, which I believe is on the left, was a 16-unit apartment built in 1937 by the grandfather of Wilhelmina Allen, who is this quote that you have up on your screen. So her family had owned it since they built it. She and her husband lived about 15 minutes from the property, and they unclogged toilets and collected rent and did all that sort of stuff. And 16 years ago, we started talking about maybe them making more money and making things easier. And it was something that they knew nothing about at the time. And we addressed a lot of the questions or concerns that we'll talk about in the second half of this presentation. But this is what Willie told me just a couple years ago, was that it was really the best investment that they could have ever made, because they had all kinds of things that they wanted to do and they didn't get to do. One of my favorite anecdotal stories of this transaction was that right the day that they closed on the apartments, they'd had this motorhome parked at the Lakewood Elks Lodge for probably 8 years that they never took out. And I was like, just go drive around and enjoy the country, and you guys have earned it. We'll figure out everything. And so I'd fax up at the time a marketing package on a property that I liked to whatever hotel or campground they were staying at. They'd look at it. If we had offers, I'd set them up at a bank to sign and do whatever they needed. And they spent the next 90 days traveling across the country, of which one of their stops was the upleg that they ultimately purchased, this Burger King with 900 locations, or a franchisee with 900 locations. There was a brand new 20-year lease. And so they really do provide people the opportunity to get that check every month and go out and enjoy themselves. Jason, you got any other comments or examples on at least the mailbox money aspect of it that are better than that story there?
No, I think that's a pretty great one. I think the one that makes me laugh is I have a client that's so used to the rent coming early that when it didn't come the same amount of days early as normal, they called me and said, I think they're going to miss their rent. And then I reminded them that today was a federal holiday and that the rent would probably be there tomorrow. And sure enough, it was there the next day. So it's just so consistent. It really does change people's lives in hopefully the best way.
They really win. And one of the questions, do you buy these sight unseen, anything like that? Absolutely not. We do a ton of due diligence on the tenant, on the location, on the lease, on the guarantee. We go look at the sites. Every property that we've sold as these examples, we put our eyes on, and we've required the tenant or the buyer put their eyes on them as well. They're still real estate deals, and you got to do a ton of due diligence. But when you do a lot of due diligence and you pick good tenants and good locations, you can get all the benefits while really minimizing the risk. You want to go to the next one? This is another example of a client who, that building on the bottom, built in the 60s. They'd operated their business out of there for 20 some odd years. It was funky in how they used it and laid it out. And once they were done with their business, they tried to lease it out for 5 years. And they made 2 runs at it. 2 tenants had left in a 5-year period. And in the best case scenario, they weren't making very much money. Ultimately, they realized they could do better. The property above is, Jason talked about the 400 locations. This is the 400 location tenant, which is Popeye's largest operator in the U.S. They double their cash flow. They got no management responsibility. And they brought a brand new building across from one of the largest gas convenience travel locations, most beautiful one I've ever seen, in a phenomenal hospital. And I think we've got a little audio of the client's kind of thoughts on this exchange. And, before we do that, the other thing that I think we talk about on this is that, there are a lot of things to look at. The client here, we sold their down leg. They got a call from another broker who promised them a double, an 8 cap for a national tenant. They went out and looked at it, and the reason we hadn't shown them the 8 cap from the national tenant was the lease wasn't very long, the location was pretty poor, and we didn't think it was going to be a long-term super stable investment for them, and we wanted them to look a little more conservatively, so that they were going to sleep easy at night. They went out and looked at that property in Michigan. It wasn't anything that it was cracked up to be, and they ultimately buy this property that made them really happy, and we'll let them tell their story.
Hey, Justin, Joe, and Angie Baker. We just wanted to call and thank you so much for all your hard work. I know I haven't been easy to deal with. We're very high maintenance, difficult clients, but you guys came through, and I really appreciate you. I just want you to know that. We're going to go ahead and move forward with the deal. We absolutely love the location, the terms. Prescott is beautiful, just beautiful.
But Justin, I think that that's a great story that just outlines exactly how the benefits of these situations work, right? Those people were able to retire and enjoy their retirement. I know one of the sellers was elderly and had been in and out of health issues. So now they didn't have to worry about if rent was going to be paid or anything else. They got the consistency that, we've mentioned as the upside of those net lease transactions.
Yeah, and our last couple of examples have talked about, people being able to move away from management headaches or challenges, whether that's getting a tenant in or unclogging some toilets. But here's another example. So what we've got here is that property on the bottom was a 100-year-old property in a city that was implementing tenant relocation fees. And by the way, because this client had owned the building for 20 years, their rents were half of market. The rents were half a market because they lived an hour away and just wanted it to be easy. They were out of depreciation and they were making less than 2% on their money. And they had studios, 1 bedrooms, older building, no parking. And they traded into a building that was brand new, almost 100 years newer, 97 years newer. 2 really emerging quick service restaurant brands, Blaze Pizza, which has a lot of prominent investors in it, and Cafe Rio, which if you haven't had the barbacoa burrito there, it might be on everybody's list. But they also got some new depreciation. They increased their cash flow, and they had nothing to do because they got a newer building, because they got a tenant that was going to take care of the taxes, the insurance, the maintenance. One of the nice things to remember about all of these, whether it's quick service restaurants, it's automotive, it's urgent care, it's a veterinary clinic, is that the brands have standards that that they require all of their franchisees and all of their stores to be kept at a certain level. We did a transaction a couple years ago where we went out and looked at a Tex-Mex brand in Texas, and we were doing our tour. The agent called me because they knew we were looking at it at, I think, 4:00 on a Tuesday afternoon. And the agent calls me at 5 and goes, "Well, how was it?" And I go, "Well, I know the brand's really good, blah, 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 but this store was really poorly kept and didn't look good." And it was whether it was the parking lot or the interior of the store really detracted, I think, from my client's, desire to own the building. Not 15 minutes later, I had the regional director of all stores calling me, asking for feedback on what the store looked like, what were all the things that I saw, because it had been relayed that I'd sold a bunch of these and sold that brand before and whatever. And they wanted to know what conversation they needed to have with their franchisee at that location to have the right image and improve the property. So you get that. It's something, the nice part about a lot of these is that not only as the owner, you have your standards and the lease agrees to certain things that the tenant's going to do, but you also have a partner, the corporate brand, that has image that they want to protect, and that they do their own due diligence and inspections and work with the stores to maintain the properties in the highest quality of care. So, I think that's another thing that people like them. Jason, why don't you talk about the financeability of these because of the tenants, because of the locations, and whether that's easier, harder, how that kind of works for clients?
Sure. So these properties generally are highly financeable as long as there's 10 plus years left on the loan. If there's less than 10, then they're financeable for different kinds of loan products. The one thing I will remind you, if you're going from apartments to, let's say, a net lease deal, is the amount of financing you're going to be able to get. Oftentimes, these loans will range from 50 to maybe 60% if you're really pushing it. It's not the 65 or 70% you might be used to on an apartment deal. Then again, though, the underwriting is much faster. It's much simpler. They know who the tenants are. The tenants often will, if they know you're getting a loan, will send you a full package in one shot that the bank needs. So it's not like you're going back and forth figuring out rent rolls and loss to lease and it's one estoppel. They'll see the copy of the lease. It's very straightforward. And if it's a franchisee, and oftentimes a sizable franchisee, they have their franchisee, financial statements. They have either the store financials or the projections. So banks tend to find these really much easier deals to get done. Like I said, though, the only thing to keep in mind is that you get a little bit lower of a loan to value. But again, these deals generally are pretty efficient to close. There's a handful of lenders out there that love to do them, and they're pretty easy transactions.
Jason, I think the next thing we should talk about and cover is that as people start to explore this and they see more inventory, they're going to see some properties are offered as a ground lease, and others aren't. Maybe for a second, talk a little bit about the difference between the two and what our clients acquire on a ground lease and what our clients acquire, what our clients acquire when the tenant is on a ground lease versus when our client is acquiring the building and the land, and then talk about why there's different benefits for different people depending on their situation with either building and the land or just acquiring the land.
Perfect. So I think that there are great opportunities in ground leases for a few different reasons. When you buy a normal fee simple transaction, for example, you're buying both the dirt that underlies the building and the building. The benefit of buying the dirt and the building is that you get depreciation off of the building, right? And so if you need more depreciation, if you want more depreciation, if you're just using fresh cash to buy a deal and you want the benefits of depreciation, you want to buy fee simple where you get the building and the dirt. Now, the land lease or the ground lease benefit is, you can get a better return. You can pay less money for the property, but you don't own the building up front. You own the land. The tenant owns the building and is leasing the land for you. The tenant gets to depreciate the building, but when the lease expires, you actually get the building back. So let's just say it's a 10-year lease with 2 5-year options. The tenant exercises all of them. At the end of that 20-year period, you didn't have to pay for the building, but you get the building for free, right? You now own the structure because you own the land underneath it. They're leasing it from you, and now you're going to end up with the property. So there is some upside there, along with the additional upside of you get, lower prices, better returns. And if you're not looking for depreciation, it's a really great option to end up potentially with a really strong tenant in that situation. Actually, I think, Justin, we did a Starbucks in Cherry Hills, Colorado, I want to say. That was exactly on this situation. The tenant, it's like the Beverly Hills of Colorado. The tenant got a much higher cap, or the client got a much higher cap rate than normal on a Starbucks in this quality area. And it was because it was a ground lease, but the client was much happier with just having the cash flow.
Well, and one of the additional benefits of the ground lease deals too, for people that it works for, is that the tenant's not paying as much rent. So their viability, their success, they're just not paying as much rent because they built the building. They're more invested in the property because they built the building, and it's easier for them to make their monthly payment because it's a little bit lower. The stability of the tenant and the length the tenant stays is only enhanced by the ground lease structure. But there's variety of options. We review them all with people to figure out what is exactly the right one for each person's individual situation.
And Justin, I think you made a great point there. While you do get potentially a much better return, there's a much lower economic burden on the tenant in those situations as well. So it makes it financially more friendly for everybody, I guess, all the way around.
In a lot of our webinars that we've done, we've talked about a blue states, red states strategy. Jason talked for a second about the flexibility of these and how they allow people that might be, moved for tax reasons, moving your equity out of California and into maybe some more tax-friendly states.
So the benefit of this is if you own the property in California and you're generating your rent there, you're going to pay tax in California because the income is generated in California. And also, as long as you reside as your primary residence in California, you're also going to pay taxes in California. Now, that being said, the benefit of 1031 exchanging to a more tax-friendly state is twofold. First, if you ever move out of the state of California, then you're going to be taxed in the state that you either live in, or if you move to the state where the property is, you'll be taxed in the state where the property is located. And so that can substantially lower your, tax burden, depending on, what tax bracket you're in. You're potentially saving a lot of money. The other benefit too is, if your children don't reside in the state and you plan to have them inherit the property and they're outside the state, they will ultimately get the benefit of the cash flow being taxed outside of the state of California. If the properties are inherited in California and they continue to stay and the properties stay in California, they're still going to be subject to that tax. It's also worth noting that, one of the reasons to potentially consider moving outside is, the city of LA has passed that new, property sales tax, we'll call it ULA. And this could spread throughout California to other cities. Long term, there might be an additional sales tax or other things that you probably wouldn't see in states like Texas or Florida or Tennessee, where there is, no state income tax already. These additional taxes are less likely to occur. So before you are going to be taxed on these properties, it might be worth it to reposition to another state. And again, you can 1031 from any state to any state. It's just fee title for fee title.
Jason, let's talk a little bit about next, why people like them, the variety. We've got a couple listed here, but there's so many different other areas that you can acquire these in. Make a couple comments of just kind of a client's ability to match up what they like with what they can buy.
Sure. So there's different kinds of properties, whether it's QSR, auto, in different price points. And so it just depends on what you're looking for as a risk profile from both a tenant and a store type. So we've had a lot of clients that are like, well, when COVID shuts everything down, I'm worried about, restaurants. That was the big thing the first couple months of COVID, or even the first year of COVID. And then we saw that fast casual and QSR restaurants actually made more money during COVID than they were before. And so everybody's like, oh, it's okay. The drive-through restaurant industry is going to be fine. A lot of people like to currently focus on automotive properties, as you know, Justin, because of the bonus depreciation. So clients that are looking for, sure, cash flow and stability, but also really looking to maximize the depreciation to maybe offset a current big capital gain or a current big income event, they're really going to look for something like an auto product, whether it's car wash, gas station, oil change, collision center, where they can get that depreciation. And then you have some people that love like a drugstore, for example, knowing that, or at least thinking that drugstores are never going to go away, even in this, new digital online delivery world. People still want to go to the store and pick up their prescriptions. They don't want them delivered to the house for whatever reason it is. There's always a need to go to a drugstore. So if you're looking for stability of tenant, many people think that Walgreens and CVS, not only because of their size, but because of what service they provide, are a highly stable tenant class. So it really is, dependent on what you're looking for. I mean, Justin, we had a client that said, I want, red states, no state income tax, corporate guarantee, publicly traded company north of a 5.25 cap. That was their requirements. I think that was the one I said that they thought that you were going to find a needle in a haystack, and you found, 18 within 24 hours. They give us some pretty interesting parameters. And for the most part, you and the other advisors are really able to hit those marks, because I think as an example, there's so much inventory available in that meet different requirements. I mean, some people, like those new construction banks that look like drive-throughs in great locations, because they're like, the bank ever goes out of business, I'm going to have no problem putting in a Chipotle or someone else in this space.
That deal in Florida was so cool. Yeah. I'm still disappointed that our client didn't buy that TD bank. Because it was exactly that. It could have been a bank or a fast food place. It had more uses than any property I've ever seen.
Main and Main on a major highway in an area where like the household median income was in the six figures. I mean, it's a pretty solid location.
Before we move on, this slide, the one thing that the additional comment that I'll make is that, like, if you think about the locations for all of these, they're really prominent on major thoroughfares. Number two, if you look at the top two, with maybe a different paint job and maybe some sharper corners, that Carl's Jr. could be a Chipotle in a matter of weeks. On the drugstores down in the bottom right, you could put a CVS and a Walgreens and a Rite Aid all in the same spot, or just trade them out, because they all use the same size. One of the things that make these good, solid properties is that in whatever space, whether it's quick serve or drugstore, almost all of the major brands use the same size building and have the same things in them. So as Jason said earlier, if you're Raising Cane's ever leaves and you've got Main and Main, Chick-fil-A or In-N-Out would be there in a heartbeat. They're very transferable from the use. Go to the next slide, because Jason brought up a great point about clients getting additional depreciation and buying gas. This is a client that we recently worked with that bought a number of net lease properties because they wanted to acquire additional depreciation. And one of the great things about additional depreciation is that if you have a portfolio of apartment buildings that you bought 30 years ago, and right now, across that portfolio, you're paying a ton of income tax, because if you have any depreciation left, it's very little. You can go out and buy one, you can do an exchange, or just with fresh cash, buy a property like this 7-Eleven in West Haven. And since they closed in 2022, they got $9 million of depreciation that they could use, that they're going to use some of it on their income in 2022, but they're going to carry the rest of it forward and use it on the future income of their portfolio to defer taxes and avoid taxes for as long as possible. So oftentimes the net lease property can be a complement to a portfolio that has little or no depreciation left, to shelter more income and ultimately increase cash flow for people with their properties.
And Justin, to your point too, it doesn't need to be, yes, these properties are available for bonus depreciation, but you can still do what we call a cost segregation study on any net lease property. I mean, in reality, you can do it on any rental property, but net lease tend to be very good for maximizing accelerated depreciation through cost seg studies. So while you might not get, 100% of the depreciable value the first year, last year, 80% this year, you can still get 20 or 30% of the building right away, which is still more than you're going to get on a straight line 27-year depreciation schedule.
Yeah, there's a lot of advantages. And I think one of the other advantages, and this shows a November closing, which if you look at that cap rate, somebody's going to be like 3.9, that's so low. It's definitely one of the safer investments. Raising Cane's is maybe one of the hottest fast food brands in the country right now. It's in Houston. It was a brand new lease. But that 3.9 cap rate, or at least the point I want to make, and why I think we're going to see a lot of investment in net lease properties in 2023, is that the cap rates for net lease properties have adjusted quicker as interest rates have changed than any other product we're seeing. So buildings that maybe were offered at 4 or 4.25, 6, 9, 10 months ago are now at 5 or 5.25. Jason, you want to make a comment about what we're seeing in the net lease marketplace as it relates to available returns, and how right now, at least, they're moving and matching the market that for available debt?
Yeah, no, absolutely. They've gone up substantially as the debt has risen because, most of these properties, people don't want to be what we would refer to, you and I would refer to as negatively levered, where the interest rate on the loan is higher than the cap rate, right? The return. And so as interest rates have continued to rise, the cap rates, because these are pure numbers transactions for the most part, the cap rates tend to rise much faster as well. And so, I think another example of this is we closed one of those 7-Eleven deals that we put into contract in June, and we closed it in November, and it was a 4.25, 4.4 cap. And then the one in Oklahoma City, which we put into contract at the end of November and closed at the end of December, was, I think, close to a 5.5 cap, right? Same tenant, same guarantor, same lease structure, same lease, and similar quality of location. But, 90 days with all the interest rate changes made that big of a change in a cap rate. And if you think about it, Justin, for our client, right, they're getting the same return from the same tenant, but they're making, 100 or 150 basis points more on their money just from the 90 days alone.
Yeah, it's really been exciting right now, whether it's the cap rate adjustment, it's the adjustment in rental increases that we're seeing almost across the board with tenants in the leases that are offered right now. The net lease marketplace is very responsive and quick to move, quicker than a lot of the other products. We've got one more reason why people do this stuff and why they love it. And I'm going to talk about this one. Quick story, that building, this is one of the first net lease transactions I ever did. That building up top, Jim and Pat, husband and wife, had owned the property for 35 years. Jim was a legendarily accomplished hockey player from Minnesota, probably back in the 50s. So that gives you an idea of how long they owned the apartment building and where they were at in life. And he was responding to, backed up toilets at 2 a.m. And they were tired of it. And so they ultimately buy this Arby's. Again, the tenant was a publicly traded company, was a franchisee. There's 1 million square feet of R&D, 2 35-story hotels, a Home Depot and a Staples, all within a quarter mile of this location in the Midwest. And as they looked at a lot of properties, not only did this make them a lot more money and made their life easy, but I think the number one reason that they bought it is that they still had a cabin on the lake in Minnesota. And every year when they'd go back to their cabin on the lake in Minnesota, they got to write off that whole trip. So whether it's family, whether it's vacation destinations, you can pick and choose what you buy, where you buy it, to have ancillary benefits beyond just making your life easier and maybe making more money with an easier tenant. So that's one of my favorites to end with. Jason talked about, whether it was they wanted it in this red state, in this tenant. People do it for vacation. They do it for family. They do it because there's places they love to ski. A variety of reasons and locations that are available to somebody when they're looking to find the right property. Jason, any last comments on why your clients like them, love them, and continue to buy them?
No, I think we've kind of nailed it today on the value and the importance of them and why people like it, right? And someone might ask too, is there a downside to these, right? Yeah, sure. You could have a tenant, you could lose a tenant, right? And hopefully, you work with the advisor to find the right property where you're not going to. But remember, you have a corporate guarantee, right? For example, from let's say a Starbucks, which would require in reality Starbucks, going out of business. And somebody says to me, why not? What happens if they file for bankruptcy? Well, we have clients that own a bunch of LA Fitness facilities around the state of California, and LA Fitness filed for bankruptcy, and our clients have collected 97% of rent on the dollar in their rents during the bankruptcy, right? So in reality, it would be a tenant going dark completely, and the guarantee not being able to, continue. But that's why I think you rely on your advisor. Oftentimes, even if the tenant decides to shutter the doors early, they're going to still pay you. They've determined that staying open is not worth it, but then that gives you time as well to re-tenant the property. So finding the right location, which your advisor helps with, and really doing the due diligence on the tenant will mitigate that risk as much as possible. And that's why I think it's such a good investment is, you can, through a little bit of work and due diligence up front, have a great return with little effort and low risk. Right. And so that's why, I think a lot of our clients continue to turn to them as opportunities.
Up next is the second half of our conversation on net lease property, which are all the questions that you should be asking as you consider these opportunities.